It's now on the market. Barry Bannister, Stifel, chief equity strategist. You can clear up some discussion we had earlier. Barry, are you long? Maybe your ears were burning. Glad to have you back on. You were bullish for most of this rally, unlike 95% probably of your peers. You think that we've seen the best near term that we're going to get?
Yeah, I mean, it was always hard to have a traditional recession when you helicopter drop more money than you spent on World War II and inflation-adjusted dollars onto an economy due to COVID. Everybody was sitting on cash, from corporates to individuals, and there was more than enough reason why we could afford the inflation that we had. The issue now is, if real wages rise, do we get productivity? If we don't get productivity, we're going to have high core inflation. It's called unit labor costs feeding through. And if that's the case, the Fed is going to have to stay higher for longer. And that's the big question. The market's waiting for an answer, and that's why the second half has been choppy since June. It's
tough when everybody that's making calls, Barry, they're not really like us, or many of them are in their 30s, early 40s, and things like this. And they haven't seen things like this before. Do you remember something called Keynesian stimulus? Does that ever work? I mean, I think we could do it, obviously, for a while and get really high GDP, couldn't we? But what normally happens is that eventually you have to pay the piper, interest rates go up, and then you don't have any money left to do anything that you wanted to do in the first place. And that, in a nutshell, is that called Bidenomics?
Well, one of the problems with economists is they tend to be dogmatic. And, I've noticed that just about every economic theory that made its way to, fame and fortune has its applicable moments. So, Keynesian kind of stimulus, if you could pull it off both directions, meaning tighten when you should, loosen when you should. They never seem to get to the tightening part. That would work. Monetarism works at certain points. And heck, even Say's law works. We added way too much demand, particularly for goods, and we didn't produce those goods. We just helicopter dropped federally financed demand with debt onto the economy.
But Barry, wages went up. Wages went up,
yeah.
But the inflation that was engendered didn't. The wages didn't keep up with the inflation that was. What is Bidenomics? Explain it to me. Is it building it from the middle out? What do you think they're talking about when they talk about Bidenomics? What is that?
Well, that's the other thing, is when you mix the, dogmatism of economists with the impatience of politicians, you end up with a toxic mix. So politicians have to work on a 2 to 4 year election cycle. This is a process that may take a generation to change. And when you try to do it too quickly, such as dropping this much money onto an economy in a short period of time, you end up with distortions. The Fed has also got distorted interest rates. They're trying to make up for the fact that they were distorting rates for 20 years by raising rates very aggressively the last year. These things all take time, and they cause ructions in the market, and that's what we're going through right now. It's just correcting mistakes that took many, many years to develop.
So you were bullish because of all that money. Are you less bullish now because of the gravy train ends, the realities of the world finally set in? Will we get when do we get when do we get new all-time highs in the S&P? What year?
That's just it. If you look at the October to June, last October to June, we were bullish. Now I'm just saying it's flat for the rest of this year. I doubt in inflation-adjusted terms, meaning real terms, adjusted for the CPI inflation, we get back to where we were at the last peak. The last peak was December 30th, 2021. In today's money terms, the S&P 500 index, which is currently 4,500, it was 5,250. So I doubt we see that for a couple more years. And so right now we're just saying flat for the rest of this year. And we're doing some tactical trades. We went long financials, industrials, basic materials for the third quarter, short the tech stocks. But most of it's just tactical at this point because we're not really in the kind of a market that has a sustained channel. It's not a bull market anymore. It was for 9 months, but now it's too late to make that call if somebody's trying to do so.
And we muddle through. We at 2%. Do we get a recession? Do we ever get back to really strong growth? What do we see in the next couple of years as far as the economy?
I'll tell you, Joe, the problem is that by not having an economic reset like you would associate with an inflation to a recession, you actually end up with inflation on the other side. So as we bump up against what's called resource constraints, we've got a sort of a vertical supply curve, only so much goods above trend that we can produce, only so much labor that's available. The prime age workforce is pretty much fully employed now. There's nobody left to grab and put to work on the prime age 25 to 55. And so when you bump up against those constraints, the inflation rate could go back up. The Fed could signal higher for longer, which I'm interested in Jackson Hole because I think that's going to be the message, is that they're going to talk not about the short term, but the long term need to keep inflation contained by being higher for longer. When that occurs, the stock market could pull back pretty significantly, and there would be economic risk in a recession.